Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management with your Fross and Fross 101. As always, please make sure you read the disclosures that were attached to this video. Or if you happen to be watching on social media, you can simply go to www.frossandfross.com and read any of the disclosures that you might find therein. So to begin with, welcome to 2022. As we were preparing this commentary, I was thinking that I can't imagine a more transformative year for America. After the last 2 years of unprecedented government actions, you can almost hear the winds of change. This year, long-term fundamentals should re-exert themselves as the most important drivers of economic and financial performance, and hopefully not the government. Now, although we're only days into the new year, we can already look back at 2021 to see how we fared overall. Sure, there were some market pullbacks. There were the jitters regarding COVID and new variants of COVID, which I guess now seem to be a little bit more of the norm. Yes, there were the labor shortages and the supply chain issues. However, on the whole, 2021 was a really good year. What I thought I would do this week is look at the good and the bad to see how things shook out, and more importantly, where we see things headed this year. So what do you want first, the good or the bad? Let's jump into the bad, because if you were to watch the news or you were to judge 2021 based on what you saw in the major media, you'd probably think that 2021 was disastrous. Throughout different commentaries that we sent you, we talked about the pundits of pessimism and the wall of worry and all the reasons that you should be sitting on the sideline last year. But on the whole, the bad things, they were not really that bad. 2021 was actually a rather smooth year if you look at the market. In fact, it was one of just 4 years now that we didn't see a pullback of more than 5% in the stock market. The only other years for that small of downturns were 1993, there was 1995, and then 2017. So even with the pandemic issues and inflation worries, markets were able to hold their own, and the sell-offs that we did see were short-lived and pretty shallow. Now, can we expect that to continue? Probably not. Historically, the 3 years with the small intra-year drops that we mentioned earlier were followed by years with larger drawdowns, as we would expect. The average pullback in the following years was 12%. However, none of those drawdowns mark the beginning of a bear market. And while we believe that we will see at least a 10% correction this year, we're not concerned about the overall annual performance. Economic fundamentals remain strong, and I think we feel that any pullback that we do see will be short-lived and should be viewed as a buying opportunity or just simply as a rebalancing exercise. Now, asset classes that underperformed in 2021 were emerging market equities and international fixed income. Probably no surprise. The best performance came from US large caps and commodities. Again, probably no surprise. And believe it or not, that's the bad news. Now, let's talk about the good news that really isn't picked up in the media. Overall, 2021 was a good year. Equity market returns and economic growth were strong, and the Fed began necessary tapering of policy stimulus. Why? Because they recognize that the economy is strengthened, and they recognize that this economy doesn't need to be on life support anymore. Now, although inflation was kind of the buzzword of 2021, volatility remained checked, and annual performance confirmed a healthy year. While we don't expect to see the same conditions and performance for 2022 due to reduction in stimulus and Fed policy change, we believe market and economic performance will be moderate, but still remain positive. That's good news. Now, looking specifically at the stock market, 2021, despite the media, was the 6th best year for US equities since 1990. The S&P 500 logged 70 record all-time highs last year. That is the second most all-time highs that we've ever seen in a year, almost as high as the number one, which was 1995, where we saw 77 all-time highs. Once again, not covered in the media. Now, on the economic front, growth was at its strongest since 1984 due to solid consumer demand and healthy housing and labor markets, while inflation, labor shortages, and supply chain issues did cause some issues. The fact that unemployment rate fell, wages did grow, and stimulus continued to help fuel spending and saving really helped shore us up against any real pullbacks. Now, as far as 2022 goes, we believe that we're firmly in the middle of this economic cycle, and we should keep expectations, I would say, in the moderate range, meaning positive, but more modest equity returns will likely be the norm this year. As we said earlier, a small contraction of about 10% would be normal and warranted when we look at the elevated returns that we've seen in recent years. As labor and material costs increase, corporate profits will likely also moderate, but we expect them to remain solid as well. Now, we see inflation remaining a bit of an issue until at least the fourth quarter of 2022. As a result, we expect the Fed to tighten policy, causing some headwinds to economic momentum. We also believe that labor shortages and supply chain blockages will begin to clear sometime in the third and fourth quarters of this year. And we expect corporate capital investment to rise as a result. We expect economic growth to be somewhere in the neighborhood of 3 to 4% this year, and supportive of a continuation of the current bull market. Lastly, there are a couple wild cards, and these we get asked about almost every day from our clients. Will China invade Taiwan? Will Russia invade the Ukraine? Well, first of all, with China, we believe it's highly unlikely, with the possible exception of some tiny uninhabited islands off the Taiwan coast. As for Russia, if your name isn't Vladimir Putin, then you don't know the answer, and certainly neither do I. If either of these things do happen, it could cause a bit of a temporary sell-off, but neither of these, in our opinion, will change the fundamentals, which are strong. We still think that the tailwinds are stronger than the headwinds. One thing we can expect for sure is the media will continue to be negative in the following year. So here's our recommendation. Tune out the news, or the noise, rather. Spend more time enjoying your retirement, enjoying your family. One thing that's COVID has taught us is how fragile life is. And hopefully we've learned what true priorities are. We beg of you, let us handle your investments, and you handle your retirement. That being said, we wish you a happy and healthy new year. And as always, please reach out if you have any questions. Have a wonderful day.